What's better than earning money from a 9-to-5 job? It's earning money while you sleep, which is made possible if you start investing. You're listening to the Real Estate Investing Demystified with your very own dynamic duo, Ava Benesocky and August Biniaz. Tune in as we discuss everything real estate, both on the passive and active sides. We feature life-changing stories of today's real estate leaders that will help build your own roadmap to success. This is a show that will lead you to a diversified portfolio, a much bigger revenue, and a next-level venture that brings you a smooth cash flow. Let's get this episode started. Welcome back to the Real Estate Investing Demystified show, everybody.
Absolutely. Yeah, movie remakes these days are really in. They're bringing back some older movies.
That's right, like The Little Mermaid was one of them.
That's right. We're bringing back a guest. So I think Logan is one of our first guests to ever come back. Was there ever a guest that came back?
I don't think so. I think Logan is.
Logan is one
he
of
was. Yes. There we go. He was so fun to talk to. We just couldn't wait to
He
get
was
back.
fun to talk to.
Yes.
We learned lots from him. He's definitely a value add, somebody that we really enjoy having him in our circle of influence and our sphere of influence. And we learn from him. We're going to talk about that on the show as well. But why don't you go ahead and introduce our guest and hit this off?
Awesome. Let's do this, guys. Okay. Logan Freeman. We're joined by Logan Freeman with over 6 years of dynamic real estate experience. He has executed over $300 million in acquisitions for his firm, FTW Investments, and as the head of acquisitions for a prior investment fund. Logan is also the managing broker at Exchange CRE, a boutique commercial real estate brokerage firm specializing in 1031 transactions. Leveraging his unique blend of people skills and transactional expertise, Logan is driving force in acquisitions, capital raising, and investor relations, and serves as a voting member of the firm's investment committee. So thanks for being here today, Logan. Welcome to the show.
Thank you guys so much for having me back. So much has changed, evolved, developed since we've talked, and I'm just excited to be here. Some of the best hosts and just people that I know in the industry. So I really appreciate being here.
Thank you.
Thanks,
Means
Logan. We had you on our show exactly 2 years ago, back in February, exactly 2 years ago. But there's been a lot that's happened in the world of real estate. So can you cover some of the stuff that's went on?
Yeah, well, I mean, you got to think about, the biggest player in the market, which is the interest rates for debt that goes into commercial real estate. And I think that has been a theme that a lot of people have been focusing on, but rightfully so. I mean, 2023, I think, was kind of a year of contrast. Some sectors surprised with the resilience and then new opportunities emerged, while others faced great challenges, more than anticipated. And what I'm trying to get across to most real estate investors at this time is that in the headlines, you may see commercial real estate, recession happening, all of this debt that is looming coming due. But you really have to focus on the details and the fundamentals, not only from the asset classes that they're speaking about, but the geographic locations. For example, we all know that office has been really challenged, and that is, probably a theme that was happening pre-pandemic, but also the change to a hybrid workforce and or working from home really exacerbated that theme. On the other side of things, right, on the multifamily side, we are now starting to see over 670,000 units to be developed and produced this year on the multifamily side. That's almost double what we have averaged the last 10 years. And they are highly concentrated in certain markets. And so again, the headlines are one thing. They're clickbait a lot of times. They want you to click onto that article. But when you get into the real estate fundamentals, most sectors have really strong fundamentals. And I think that is an important piece to keep in mind. Now, what the challenge has been for the last 2 years is how do we get deals done? Because with the seller and buyer void, I'll call it, that we've had with prices and with where debt is, that has created an imbalance in the marketplace. There is no equilibrium. That's starting to change, in my opinion. I'm starting to see transactions happen, especially on the smaller side. So $1 to $3 million type of transactions. The other thing that happened was 1031 exchanges really kind of dried up. And I can speak to that because our brokerage is called Exchange CRE for a reason. We represent a lot of 1031 exchange buyers. And so they weren't selling their properties because they didn't think that they could get the price that they wanted to. We also have bonus depreciation potentially coming back here. That could be a big driving force. The other thing that I'm tracking here is the 18.6 year real estate cycle. for the last 200 years, you can kind of look at real estate prices going up for 14 years, coming down for 4 years, give or take 2 years. So I'm studying and trying to understand where we're at in the real estate cycle to position ourselves and our investors in the right places to make sure that we capitalize on this real estate cycle. The other
Amazing.
trend so the other trend that I'm seeing is a lot of equity investors starting to turn to becoming debt investors. And this trend really is important for two reasons. One, investors may be looking for a different opportunity, but two, I think that people are worried about especially multifamily debt coming due, but there has been billions of dollars. There's over $402 billion of dry powder that has been created into fund-like structures, either debt or equity structures, to help these investors out in these deals. So I believe that when John Gray of the COO of Blackstone says we are seeing the market bottom for this cycle, I believe his assumption is correct because the Green Street Property Price Index has increased 0.3% since January and it's trending upwards. We're currently right now on the whole index, we are exactly where we were back of the valley of COVID-19. So I think a lot of investors are saying, oh my goodness, basis is really good right now. How do we make those deals work? And that's a completely different conversation in regards to the capital stack and leverage and different things. But I see this year as the start of the next 2 years of deal making happening.
Nice.
Amazing. Yeah, lots to unpack there. A lot of interesting topics you brought on. The bonus depreciation coming back. We'll talk about that. The 18.6 year real estate cycle that's been going on for almost a couple hundred years. We'll talk about that. We have some questions coming up. But
Good.
let's talk about investors going from equity investors to debt investors. Maybe we can break that down a bit. But what I'm seeing also is a lot of syndicators who are over leveraged and got these risky loans. We have here at CPI, we haven't done a deal in 20 months now. And in retrospect, it was a great decision because deals were just not making sense in an increasing interest rate environment. But there was a lot of groups who had, large number of employees. They had to do deals to keep the lights on, and they went in these deals. And now, their 3 years is maturing or is about to mature, and they're finding themselves in a pretty bad situation. I've noticed a lot of them are starting debt funds, and in their PPM, they actually have, even in their fund, webinars, they're openly saying that the fund they've created is actually to rescue some of their own deals. So how much of these rescue funds that you see coming up, how much of that is investor interest wanting to go from investing as equity, into debt, and how much of it is syndicators or other groups trying to save themselves?
Yeah. Well, I think that it's both, but what I always like to try to do is what is the 800-pound gorilla in the room doing? And that is Blackstone. They manage over, I think, $1 to $2 trillion in assets, trillion with a T, and they have themselves have over $202 billion in their war chest. And so I'm looking to see kind of what they and KKR and some of the other big asset managers are really focusing on. And what we're seeing is they are switching their allocations from equity to debt to the levels about 20 to 25%. And that kind of matches back into where we're at in 2018. And so I think that they are looking at these opportunities as, can we become the bank and the equity for those deals until we can go get some different loans that might make sense. So that is one trend that is definitely happening on much larger deals on a larger scale. However, the other type of investment that you have discussed and described is really rescue capital. So this is where people need to either go and put more money into the project because they weren't hitting projections and or they're not covering their debt service coverage ratios and their covenants. And, frankly, I think a lot of these operators, and unfortunately for them and or their investors, the basis just may be too high. And so what I'm wondering and what I'm interested to see is, with this rescue capital, what type of control provisions are actually created, meaning the fund that's coming in to put more capital in. I highly doubt that they're willing to put capital into a project that they don't have control provisions to take over that deal. And so is it really rescue capital or is it more predatory lending? That is really what people have to discern right now. And in regards to, these sponsors, raising funds to put more money back into the same deal, the PPMs should sometimes allow for, member contributions that either are equity or debt. Now, there needs to be a really strong story in regards to what is that capital going to be used for? How is it going to be paid back? And then how does that impact my equity return? I have not been a part of and or seen any opportunities where folks have gone to their investors and or other investors and said, we need to put more dollars into the project. However, we're going to do it as a loan and that be successful. That's, I'm sure that is happening. However, it's kind of a confusing position to be in as an LP when you get that call. So I'm going to put more money in as a loan, basically, into the project. How is that going to impact my returns on the equity side versus is this just a way to try to save the deal? And if you have debt that is not coming due, I would say that might be a good option. Now, if you do have debt that's coming due, we know that the capital markets are still in disarray. And debt service coverage ratios need to be able to get to 1.3 or above, and that needs to be on a trailing 12. Unfortunately, a lot of that is not happening because of the basis and or the new supply that's coming online that is creating rental price decreases, not increases, in certain asset types and in certain geographic locations. So it's very specific use cases, and each one is unique and different. However, if you think that there's an option to actually put money into a project, whether that be on a debt or the equity side, and you can get it stabilized to the point that you're not worried about, another interest rate increase or something along those lines, I would say that might be a good opportunity. But if we're saying we need to put money into the deal to get stabilized and we need to refinance this loan, that's a really tough position to be in, and one that is going to be interesting to see how it plays out. I just haven't seen really any of those scenarios yet.
Yeah, and I think some of these groups are doing it not to do capital calls to their investors, but rather bringing on this form of quasi debt but it'll dilute their investor returns for sure. So I'm just wondering how the mechanics of this works, but they've openly advertised it as they'll be rescuing some of their own deals. And I've noticed a bunch of syndicators in my inbox that are advertising this.
Raising capital for the debt fund.
Yes.
Absolutely. Because you know why? Because true preferred equity cannot be put into a deal typically. I mean, there are scenarios, but it's very difficult to put that into a deal behind an agency loan. Those loans are very tight with their covenants and the restrictions that they have. And so they're looking for ways to be able to infuse capital. I just think that there needs to be a really strong plan of how you get stabilized and how that capital is returned.
Yeah, absolutely.
Logan. Now, Logan, you own your own firm, FDW Investments. What do you guys do? And what asset class do you focus on? And what's your guys' business model?
Yeah, well, I mean, I think that it has been transitioning and shifting as we have been doing business since late 2018. We really got started doing Class C multifamily apartments, value add apartments. And as we all know, that market got really heated up. And so we were not finding any opportunities. And similar to you guys, we've only done one deal over the last 24 months. And so we're in that same boat. However, we did reposition our investment thesis into more commercial assets. And this is kind of a reposition because going into COVID-19, we actually did have about $35 million of neighborhood retail shopping centers under contract. And then the pandemic happened. And so we had to reset our focus. And so we've been stepping back into the commercial real estate space and have added around 600,000 square feet of commercial assets into the portfolio. These are neighborhood retail shopping centers and flex industrial properties. And so the reason being is I'm able to find really solid mom and pop owners that have owned an asset for 15 to 20 years, and they need to have the parking lot redone. They need a new roof. They need new facade. They need lights, new signage, all of those different things. And unfortunately for them, they've used the asset as a way to live a certain lifestyle, right? And so they weren't keeping money back into different reserves to put back into the deal. And so now they might be at 80% occupied, 85% occupied. And so to get them released, money needs to come into the project because commercial tenants are a lot different than residential tenants in the sense that they're signing a 5, 7, 10-year lease. And if they're changing the use of the space, that build out can be very costly. And for a lot of regional and local owners of businesses, they don't have the cash to put into that space. And so you as an owner of the building need to be able to structure a deal in regards to, okay, you guys are going to put in this much. We're going to finance the rest of this build out for you through either a construction, loan that you have and or the equity that you've raised. And we're going to lock you into a 5, 7, 10-year lease, but the build out is going to be very costly. That's good for the property owner because those are typically sticky tenants. let's think about a dentist, right? If a dentist is going to start a new practice, we just signed a big dentist lease in one of our shopping centers. They have a massive build out. Not only that, they have a big equipment that needs to come in there, costly equipment. And so they are building a practice, a business, a customer base in that shopping center because it's surrounded by the folks that they want to serve. And so that is extremely sticky in that regard. And I love that opportunity for these shopping centers and these flex industrial properties because tenants typically do not want to leave if you have a good located building because they're building a business inside of that. If you go to the residential side, if I can find a cheaper apartment down the street that has the same amenities, I'm not necessarily stuck to that residential building, right? And so we've been transitioning kind of our investment thesis into this space. And if you've watched the Wall Street Journal for the past, I don't know, 18 months or so, they've really started to hone in on neighborhood retail shopping centers and the trend that, hey, look, 86% of all retail sales still happen in brick and mortar locations. That means the web penetration is only at 14% and peaked during COVID-19 at 16%. That's over $4 trillion industry is the retail trade. 1 in 4 Americans are employed by some sort of retailer. It's a huge industry, right?
And so does food fall under retail?
It does. Yes.
So that's the people don't have a choice. They can't go on Amazon to buy a pizza. So
that's exactly right.
Got it. And we'll kind of break down, retail and shopping centers in a moment here. But talk to us about the shift that you guys made here at CPI. We're focused on multifamily, and internally, through the difficult times we've had over the last 20 months, rather than expanding our buy criteria, we actually became more focused just on Florida, particularly Jacksonville, Tampa, Southwest Florida,
sure.
East Coast. This idea of expanding and looking at other regions, potentially looking at other asset classes, seems like a very difficult task. Talk to us about that transition. Is your experience as a broker managing, also having other team members, did that make the process easier because you understood the business model and how the business really ran? Talk to us about the transition and the shift that you guys made.
And then to add to that, Logan, maybe you can talk about what it was like for investors, right? Because you educated them about multifamily, and then
we'll get into the investors. We'll just focus on internally your team as GPs, because I'm going to get into the investors as far as what type of economics they look for when they're looking at retail compared to multifamily.
Yeah.
I'll get into all of that, and are they cash flowing? I'll get to that in a moment. But talk to us about internally as a GP. How did you guys go about learning about this new business, which is possibly vastly different than multifamily value add?
Yeah, like I mentioned before, I'm going to clarify that going into COVID, we were focused on neighborhood retail and not multifamily. So it went from neighborhood retail and commercial assets to multifamily, back to neighborhood retail and commercial assets. Why? Well, I had done a lot of retail brokerage in my past life. We had a lot of 1031 exchange buyers that were interested in buying stabilized, neighborhood retail shopping centers. So I had been a part of so many of those transactions. I saw that value. However, they were typically looking for something that was stabilized. I wanted to go in, find the asset that needed the value to be added, and then stabilize it. And that way I could compress that cap rate. And so one thing that I will mention on this as well is one of my business partners has been in the retail and office brokerage, leasing, and development space longer than we have in the multifamily space. And so, it just kind of was a pivot from commercial to multifamily back to commercial. And so how we have managed this was, well, our strengths and our skill sets really were in the retail side before they were in the multifamily side. And we have hired a 35, 40-year veteran on the commercial property management side to manage those assets. And so bringing somebody with that expertise on to be able to manage those assets has been extremely important as we have transitioned, build investor confidence, and actually go implement the business plans. And the business plans, I think, is an important part to speak about because these are more or less larger CapEx projects and less of, internal just rehab kind of units. And so you actually get to work with really large contractors that focus specifically on asphalt or specifically on painting the building or lighting or facade or, something along those lines. And so you really get to deal with larger companies that are specialized instead of what I call the chucks in the truck that show up, can do the electrical, they can do some plumbing, they can do some painting, some drywall, those types of things. So managing that process is a lot easier on our end. This is the hardest part with neighborhood retail is, how's the leasing going to work, right? And so this is all about location. And so we work with 2 or 3 different leasing groups here in Kansas City that really specialize in specific geographic locations. And I want to point that out very importantly because one leasing team may be really good at Johnson County on the Kansas side, and one may be really good on Eastern Jackson County. People have specializations in regards to leasing, just as property managers would. You wouldn't hire a residential property manager to manage a 615,000 square foot portfolio of commercial, right? And so that's been really important, is to just make sure that we have the right vendors for the right assets, and then have the internal team bringing our skills and experience, but also hiring on the property management side. One property manager can really manage,
Mhm.
anywhere from 500 to 600,000 square feet, because you're not dealing with 500 tenants, you're dealing with 50,
That's
right?
right. That's right. And
Yeah.
then our retail shopping centers, is it triple net always or
We
usually?
love to buy modified gross and gross leases and implement a business plan, and then work with the tenants to move them to triple net leases. So
Explain
you'll
that. Explain
typically
that. Explain the difference.
So you'll typically have a mix of triple net lease, and triple net lease being they're going to pay their portion of the taxes, insurance, common area maintenance, right? But you may have a tenant in there that is just paying base rent, and they have a flat fee for a utility or something along those lines, right? And so that would be more or less a gross lease, or a modified gross lease where they pay a base rent and then they might take a portion of the taxes or a portion of the insurance. With the mom and pop, I have seen so many different lease structures. It just kind of blows your mind with what type of leases that get put in place. But our goal is to go in and to focus on adding value to the shopping center, to show that we're focused on, one, elevating the safety and the look and feel for their customer base, and then implementing a robust leasing strategy which will allow more traffic to those businesses, right? So you have to look at the tenant mix very closely. So you might have a chiropractor, you might have a dentist, you may have a veterinarian, you may have a restaurant, you may have a hairdresser. You want to make sure that somebody is going to show up to the shopping center and they're not just going to one location. They might go to 3 or 4 different locations in that shopping center. And so if you can show that you're adding value, making the cosmetics look better and making it more efficient to be an operator in that space, then you go to them and say, "Hey, I know your lease is coming up." And we always look at weighted average lease term, WALT. And so weighted average lease term just says, okay, on average with this shopping center, we have 20 tenants. When are those leases renewing? We're looking for a weighted average lease term under 2.5 years. That way we can go in, implement this strategy, and then renegotiate these leases. If the WALT was 5, you're basically buying a stabilized deal. And that's fine for 1031 exchange buyer, somebody who's looking just for, a coupon. But we're looking to be able to actually implement a robust, modified gross to gross leases to triple net lease, to add that value for ourselves and for our investors. What that does is allows us at the end of the hold period to say, okay, we have done the roof, we've done the facade, we've done the parking lot, we've done all of the HVAC, and we've moved all gross leases to triple net leases. And now we can take that cap rate from an 8.5% cap rate that we purchased at and sell at the market cap rate, which is 7%. And so that's where the value really starts to be created in these neighborhood retail shopping center
Got it.
deals.
Neighborhood retail shopping centers, is there always an anchor tenant or it could be without an anchor tenant? Is bringing an anchor tenant actually is a value add or could it be a negative? Or talk to us about anchor tenants.
So your typical anchor in what REITs and large equity groups will look for is a grocery anchored shopping center, right? We typically do not purchase those for a multitude of reasons. One, the cap rate is usually a lot lower, because if you have a grocery in there, you're thinking, okay, the traffic's going to be really high, so you're paying a lower cap rate. We typically focus on unanchored neighborhood retail shopping centers. We may have some national credit tenants in there, like a Cirque or a national franchise or something along those lines, but we have usually a good mix of regional, local, and national tenants in there. What I'm looking for is not one tenant to take more than 20% of the gross leasable area, or GLA. That way, we could say, okay, out of these 10 tenants, not one of them is going to have a massive impact if they leave the shopping center. And so we're looking for that to be under 20% on these shopping centers, which kind of gives a diverse mix of income. Maybe one industry goes down, is pulled down. Just think about meal prep services. Those things were popping up everywhere. They had retail locations left and right. Well, during COVID, those things went away, right? And so we're making sure that if one space leaves, it's only 2,500 square feet, we still have 18,000, 20,000 square feet occupied, and those leases are always rolling on different time periods as well. And so we're looking for unanchored shopping centers. I've looked at a lot of really national credit grocery anchored shopping centers. We're just not as competitive with those deals because larger groups that have lower cost of capital typically come in and buy those.
If you have the square footage, could it be part of the business plan to actually build out a unit for an anchor tenant, and that's like the business plan? Could that ever be the case?
Absolutely. Absolutely. So think about these for as kind of suites in a strip center, right? You can take a wall down, depending on how it's configured, and create one 2,500 square foot space into a 4,500 square foot space. And so as long as you have vacancy on that space, with what we're trying to do, we have 3 shopping centers within 4 miles of each other, right? And so I'm able to work with all of those tenants and say, okay, you've outgrown your space. We have a shopping center right down the road that we can actually move you to and make more space for you. And so once you get economies of scale in a certain geographic location, the leasing becomes much more robust because you have different options for these tenants. So absolutely, you can create more spaces for the right tenant. So as long as they are willing to sign the right type of lease.
Got it. Go ahead. You want to?
Yeah, I was gonna ask Logan, in retail, like what keeps you up at night? Like, for example, in multifamily, some of our concerns are the debt, debt
Mhm.
changing, hyper supply, rents dropping. What are the risks in retail centers? Are they the same?
I mean, I would say that, they're not building new retail shopping centers because they can't around the suburban neighborhoods that we purchased. Because if there was land, what was built? Well, multifamily was built or
Right.
an industrial building was built. Typically, neighborhood retail has not been built unless there is an anchor tenant that you are going and building that shopping center for. And that's usually a much smaller space and or a single tenant net lease deal. What keeps us up is, okay, is there a reason in regards to the tenant mix that we have that some sort of impact like a COVID-19 or a pandemic could really impact these businesses? And so you have to look at, is it the type of businesses that you have in there? Are they essential businesses? Because essential businesses, even during a pandemic, were able to stay afloat
But
and
aside
stay
from that,
open.
aside from a black swan event, is there something else that like what bring concerns? Is there? You were talking about having a good ratio, not having one
Yeah.
type of business there. So if that business goes down, it doesn't affect
Yeah.
it. Not having more than 20%. But what's your guys' biggest concern? So it's not hyper supply because infill is
Hmm.
difficult to build shopping centers. But is there any other concerns? Because I'm
Yeah. I mean,
a believer already. So tell me
yeah,
about.
so the main concerns for me really are these tenants willing to buy in to the program from moving from modified gross leases to triple net leases and paying market rent? Because the hardest part is a lot of times from buying a mom and pop is they've never raised the rent. It's been 13 bucks, a foot modified gross for this last, 10 years. And so it's been difficult in some scenarios to get some spaces to say, look, we buy into this, or they just can't pay. And that's sort of the business model as well, is you want to make sure that you don't raise the rent so high that you have large vacancies coming. And so the risk is really you have to sit down with each one of those business owners, learn about their business, learn about their credit, what's driving them, what's not driving them, and seeing if they even can pay. And so it's much more of a forward looking planning session with these businesses, with these tenants. And so my biggest risk is, we got a WALT of 2.5 in 2.5 years. All those tenants say, bye bye, I'm leaving all at once, right? And so that's the hardest part with these deals, because if you do have a shopping center and only has 6 tenants, well, if 3 of them do leave, then you do have a large amount of vacancy and your cash flow goes way down. Now, that can be counteracted by buying in the right areas that have submarket vacancies lower than 5%, but you're still going to have downtime. So you have to plan for that accordingly. So that's my biggest risk on most of these shopping centers, is getting people to buy in and making sure that they move their leases from modified gross to
Got
triple
it.
net lease.
How
And
about
that's kind of
crime?
a business decision.
How about
Yeah,
crime? You've seen it with Walmart closing down actual stores just because of
Right.
the crime and smash and grab or whatever you want to call it. How about
absolutely.
crime increasing
Yeah.
in a certain area?
Yeah, 100%. I mean, we look at these deals and median household income has to be above 75,000 for us to be really interested. Traffic counts have to be above 15,000 cars per day. We're very, very specific on going into certain locations. I would say that we've mostly focused on Johnson County, which is the Kansas side of Kansas City, I will call, because Kansas City, you've got Kansas, you've got Missouri. Johnson County is on the Kansas side. Really good school districts, really high kind of median household incomes, and the houses around there, they do have disposable income to shop. And so that is very specific. We've only bought in 2 different locations in Kansas City, which, can be a detractor from growing this portfolio. But it is also why larger groups haven't got into neighborhood retail, because it's very difficult to do at scale. So those are kind of my thoughts on the crime. Is we're just not willing to go into any area that has high crime, and or that's pretty easy to either know because I live here, or just looking at the statistics.
Yeah, and you guys are not remote investors who just look at something online and make an investment. You guys, have been in the area for a long time and understand it intimately.
Exactly.
Barry Sterling was talking about this idea of partnering with local experts, and you guys are definitely local experts. You know what area makes sense, what doesn't. Let's talk about underwriting. In multifamily, there's certain rule of thumb, like 50% of the NOI goes to management costs. What are LPs would invest? What type of debt exists out there for multifamily? Certain kind of rules of thumb. Is there such a thing for retail shopping centers? What kind of cap rates are you guys? Give us a breakdown of how do you guys underwrite and
Yes.
what you look at.
Okay, so basis is the number one thing, right? Okay, so we're not looking at per square, we're not looking at per door, right? That's just not what we do here. We look at per square foot. And what am I purchasing per square foot? Because even if you take a deal from an 8.5% cap rate that you purchased at, and you believe the market cap rate is 7, after stabilization, if that per square foot is $100 more than what the market is saying, you're probably not selling at that. That's very important to notice, because per square foot versus per door on a cap rate on NOI is two different things. And so we're looking for deals that have anywhere between $85 to $125 per square foot in good locations, because I know it's going to cost somebody $240 to go build this thing, and there's no land to do that. So I'm insulating myself just from a basis standpoint, number one. The second is vacancy. This is much different than multifamily, because you have to stage the different vacancies. Cash flow can be very lumpy in these deals based on when the leases are actually coming due. So we have to use a program that is very similar to Argus, that looks at the leases, looks what they're paying for the triple nets, and or what they're paying on taxes and insurance when those are rolling, and then make some bets on the probability of them renewing their leases versus leaving the shopping center. And so that's a pretty complex process that we use a very specific underwriting tool to help us understand and look at. But rules of thumb: 10% vacancy, hold it at that all of the time, and make sure that you keep 4 to 6 months when a property is, or when a space is coming for renewal, that you have to make the space available for somebody else, and then downtime on the leasing side. Looking for
Rent
cap
growth.
rates.
How about rent growth? What do you
Rent growth is kind of unique in this scenario too, because we're looking at a lot of these deals that the market may say it's $18 triple net lease, but somebody's only paying $13, and it's like, okay, well, do you really bump them up to $18 per square foot? Now, rent growth has been between 2 to 3%. I think the highest year in 2022 or 2023, yeah, I think it was 2022, was closer to 4.7% here in Kansas City, which is great on the retail side. And it's still continuing to stay positive and grow, because there's just not as much supply for these spaces. So that's that. And then on the cap rate side, we were selling these things pre-COVID at an 8.25% cap rate, stabilized. That has dropped, and it has dropped substantially in certain submarkets, because people have started to say, man, I'm really looking for something that's a little less headaches. And we had a lot of 1031 exchange buyers kind of coming into the market. And so people are looking for different diversification, because I feel like a lot of folks have gotten really allocated to some multifamily. And so when the Wall Street Journal starts posting about the darling of the industry being neighborhood retail, we see firms like Nordstrom creating smaller footprints in shopping centers and around neighborhoods. That's driving a lot of capital into the space. And so we're typically trying to buy above an 8% cap rate, and looking to get, back down to a stabilized cap rate between 7.5 to 7.75. I think that we can sell these things for a little bit better than that, but I don't ever really like to be super aggressive, because it go back to the per square foot basis. We have to make sure that we're in line with the historical trends, because I can't say, the next 5 years, retail shopping centers are going to sell for $225 a square foot. There just may not be a market for that. The great thing about these things is they typically cash flow. If you're buying at 8.5% cap rate, there's usually a good plan to getting, occupied, and then they stay occupied because you have longer term leases and you have time to plan for the rollovers.
Got it. Yeah, and these long-term leases, when it comes to industrial and retail, they're really helpful, because what the tenant is paying, and it's pretty difficult for those tenants to make a switch. But real estate has this, very wide spectrum of a rate where hospitality uses. They can switch their rates on a daily basis, and then you got industrial and retail, which is in some cases 10-year lease. Talk to us about the positives and negatives of having these long-term leases in play.
Yeah. The positives would be
Sorry,
that,
forgive me. And at times also when these contracts are made, there's actually a clause where depending on certain circumstances, the owner can increase or by the rate of inflation. Talk to us about that as well.
yeah, absolutely. Again, there's a lot of different lease structures, and based on the size of the business, the credit quality of the business, you have to make those kind of decisions. But I have seen it done multiple different ways. Whether you just have regular renewals increases based off of the years that you have in your contract or your lease with the tenant, or you can tie these things to CPI. And the challenge with that is, where we've been the last couple of years with, the inflation being 8, 9% or whatever, the metric is that you want to, can a business really pay that? That's really tough in those kinds of scenarios. And so the downside would be, hey, you're locked into a long-term lease with someone that you don't have a lot of renewals. Now, if the renewals and rate increases during those renewals. Now, if they are triple net leases, you are insulated in a scenario with what we're seeing in the insurance markets right now to say, oh my goodness, insurance has gone up 200%. You can pass through a lot of those costs, but again, can you pass through all 200% to your business that's in your shopping center? That can be tough. And so you have to have some leeway, you have to have some flexibility with these lease structures and what you're going to enforce. With most national credit tenants, those things are negotiated very strongly with their internal real estate teams, and everything is lined out. With more local and regional tenants, you have to be involved in that and say, hey, look, our taxes went up 100%, our insurance is going up 100%. What can you do in regards to increases? And you may have to stage that over a certain amount of years, and or be willing to work with them on some sort of financing kind of a situation.
Got it. Is ever the business model switching the zoning from retail into some type of mixed use to increase returns or what have you? Have you seen that, or building? I've seen that a lot of malls closing down in metropolitan cities now. They're building high rises in the location of the mall. Is that anything that ever happens in retail where a portion is used for mixed use or building condos or apartments?
I have seen that happen with some malls, and more or less the malls moving to kind of a medical type of use, right? So maybe a big urgent care and or a hospital system that needs more footprint that would go into a mall. What we see more regularly is you buy a shopping center that has a large parking lot, and Scooter's Coffee or a Chase Bank contacts you and says, hey, I'd really like to take this out parcel and build a building. So now you're structuring a ground lease or 25-year ground lease with a Chase Bank or a Scooter's Coffee from a part of your parking lot that is really valuable, right? So you could sell the real estate after that ground lease is in place to a single tenant net lease purchaser, and or just sell it to the operator that's willing to build their space there. And we've actually done that on a shopping center. We had an out parcel building. It was knocked down, and Community America Credit Union came in and bought the land and built a brand new building right there. It infused $700,000 of equity back into the deal, and we were almost at par with the equity on that project. So that's what I see more often, is being able to buy a shopping center, configure as long as you have enough parking requirements taken care of, configure an out parcel, figure out what to do that with that out parcel to add value to that whole opportunistic deal. So that's kind of what I've seen. Now, I do want to mention one thing. I have been a part of some transactions in the Crossroads, and the Kansas City Royals just announced where their new stadium is going to be. And I've helped some owners redevelop some mixed use buildings, whether that be retail on the main level and apartments up top or short-term rentals. And they have had to go through some change of use, and or zoning, but now they're sitting in an area that the Royals need to purchase their real estate. And so again, location, location,
Yeah.
location. But I'm working with those owners currently.
Yeah. You find any of those deals, make sure you let us know. But
Yeah.
let's get into LP economics. Ava was eager to get into this, and of course, as investor relations, you're talking with investors on a daily basis. But
yeah. Talk to us a little bit about the LP economics, Logan. Are these deals cash flowing out of the gate? I'm curious how long. What's the hold term for these type of deals that you tell investors?
Absolutely. Yeah, I mean, we're not buying negatively leveraged deals, and so we are typically purchasing these at an 8.5 to 9% cap rate on current income. and that's tough to do, but that's what we're doing to make sure we insulate ourselves against any market downturn or any type of exit strategy. So that's important. So the cap rate's much higher than, most multifamily opportunities. We like to buy buildings that are at least 70, 75% occupied. That's going to be cash flowing very little for the first 12 months, but it allows us to have enough cash flow into the project where we're not having to do something to the deal to pay, the loan off, to make to make a preferred return payment to our investors. But we typically say there's usually going to be 3 to 4 quarters on these value add retail shopping centers before we're going to start making distributions. We're building up the war chest. And why? Well, because we don't know if when we take over that those tenants told us that they were going to stay up and leave. And so we're trying to get in, take over the management side, really build the relationships for a good year, get a good philosophy of who's staying, who's not, and then we can really start to make sense of should we distribute capital to our investors and where are we at on the leasing side. Again, we are also then, day one starting on that CapEx program. So those tenants see that we're, redoing the parking lot, we're adding signage, we're adding lights, we're making the shopping center more available to them. So what this really amounts to for LP investors is usually an 8 to 9% cash on cash return. It's pretty steady when that gets started. There's not a whole lot of change to that. And then, equity multiples are anywhere between 2 and 2.5, and internal rate of return highly dependent on your exit, right? So, I mean, I can make that look a lot better than what it is usually 17 to 19%. And so they're not very sexy deals, but they are just a nice complement to other opportunities that, are maybe heavier value add and or less cash flow during the hold period. Hold periods typically just time it up with the debt. So look, if I've got a 5-year loan, I'm going to model out at 5 years and then look at what an exit is. But the plan with this commercial real estate, and this has been the plan all along, is buy in good areas, invest, wait, and appreciate. Because I know that in these areas, if we hold this real estate long enough, there is just going to be worth so much. I was having a conversation with a guy yesterday in Nashville, Tennessee, and we looked up some tax records that he was looking at. And somebody had bought an office building for, $500,000 and now has a loan on it for $22 million, right? I mean, that was over 25 years, but that's the kind of stuff that I'm looking for here is how do we hold this in perpetuity? Because my goal is to get a strategy implemented that we not only have 6 of these things, we have 60 of these things. And if I have 60 of them, then I can go to a private REIT and or a public REIT and say, you want exposure to neighborhood retail, but you haven't been able to get to scale. I've got 60 deals across 5 or 6 states that you can step into and buy all at once. And I have not seen that done. And I think there's a huge opportunity there.
Very cool, Logan. Awesome. Now I'm curious, what is your investor profile? As I was kind of mentioning earlier, do you see a conversion from the multifamily investors to this asset class?
Very few. It took a long time, 18 to 19 months of education on why folks should be interested in this asset class, why we are interested in this asset class. Most of the time, it would be new investors that have reached out to us after that marketing had been in place, talking about the opportunities in the neighborhood retail and the flex industrial spaces. I would say that industrial has been easier to transition multifamily investors over to, maybe because the headlines say how hot industrial has been or is, or maybe it's easier to understand. But you got to look at my investor profile, which is a lot of accredited investors from tech companies in California and or other markets, and they might be in the internet space or the software engineering space, and they may not utilize a shopping center in their market, right? And so I've had a lot more Midwest investors that really believe in these neighborhood retail shopping centers versus kind of California investors that are like, look, I just buy everything offline. I don't go to the grocery store. Well, I understand that. And so, it has been a difficult proposition for them, but we have transitioned a decent amount of those because I think the over allocation to multifamily and or maybe some of the projects that they're in that aren't producing the cash flow that they thought they were, they're looking for some other type of diversification. So it seems like the investors are definitely coming around.
Got it. Couple of quick questions for you. When you rent these units out, you talk about CapEx and what have you. Are you renting out just the shell and then the tenant comes in and builds what they want?
We will do that, but more or less the time, what we call it is tenant and landlord contribution. So we've got a package for the dentist that's coming in and saying, okay, what's the build out need to look like? Okay, what can you guys afford to put into the deal? You need to put some money into the deal. What needs to be financed from our end? And so we will amortize that over, 5 years for them or their lease period. of what that looks like for them to get their build out done. We have spaces that are 2,000 square feet, 1,500 square feet. They buy it, or they sign the lease, they turn the key, and they do everything themselves. So it kind of just ranges on the spectrum of what the use is going to be, but not a whole lot of build out unless it's going to be a medical use or something that is a huge change of use for us in these shopping centers.
Got it. And the next question, you mentioned cash on cash, you mentioned IRR, equity multiple, but how about average annualized return is a metric that we look at a lot. And for example, the reason we haven't done a deal in the last 20 months is because we haven't been able to hit that minimum 15% average annualized return. Is there a minimum number in an average annualized return that you will not touch it if it's less than that?
Yeah, I mean, typically it's similar to you is 15%. However, I will say that I've had a few investors with pretty deep pockets say, look, you get better credit, meaning more national credit, and you can find a 12, 13% return, and it has a 7-year lease on it with a person that's a national grocer. I'm interested. And so the hard part is finding that opportunity because those get bought for lower cap rates and it can be difficult. The way that I look at those too is I got to look at this deal like this grocer is going to leave. And if they leave, what are we going to do with that space? Right? Am I going to have to attract another grocer? That could be a difficult proposition. I mean, these folks will leave. National credit tenants will leave. We're seeing it happen in Walgreens and CVS's. They're shutting their 15,000 square foot space down and going across the street and opening up a 5,000 square foot space. And that one tenant in that building really just demoralized the whole project's return. So typically 15%, but if it has a really strong tenant and we do have an investor that's asking for that and or we know is really interested in that, we might get a little bit more aggressive on that front.
Got it. Still a few more questions. Are you still okay for time? We got a few more questions to bang through here. All right, great. So now, as far as let me see here. All right, maybe we can work on a couple of other items here. Great. Let's do some market predictions. Sorry. Before we get into that, debt. Who lends to you guys? Is it mainly private? Is agencies even an option on retail? Like, talk to us about that.
You can get a CMBS loan for a large enough project, but we have only used regional and local banks for these types of assets. So that
Which
is
sometimes are pretty good. The regional banks actually have great rates. We've seen that in kind of single family development that regional banks have the best rates out there.
yes. Now that is full recourse typically to the
Yes.
sponsors, and so I mean it's completely different from a guarantee standpoint, but that's what we've worked with in the past. I would say that if we do get to 10 or 15 of these, looking at a large cross collateralized loan across all of these projects, it could make sense. But they need to start to get to being more stabilized, right? Because I'm using a regional bank because they're willing to give me a construction component to this to go execute that business plan.
Got it. And let's talk about predictions. So it's February 2024 here. What are your predictions when it comes to what's happening with the interest rates, the debt aspect of our business? What are your? Do you believe Jerome Powell, the chairman of the Fed, that he's going to decrease rates 3 times this year?
Yeah, I mean, I just try not to bet against the Fed. They have telegraphed what they're trying to do. And I mean, I think that the market's had 7 or 8 cuts, in the market that has been squashed now. So I'm less being a prognosticator about where interest rates are. I'm more or less trying to understand where are the basis, where are we at from a basis standpoint? Is that going to go up? Is that going to go down? What deals do I have coming for refinance? Because we started purchasing in 2018, 2019. So next year that will be coming to fruition on most of my 5-year fixed rate deals. And so I have to be thinking about that. Do I refinance now? Do I sell now? What does that look like? So we go through a hold, refi, and sale analysis on a quarterly basis for each one of the assets to make sure that we're staying in front of that. But I do see some trends that, in my opinion, the prices across the board are going to start going back up for at least the next 16 to 18 months. And I think that's the 18.6-year real estate cycle that we talked about. That's bonus depreciation coming back. That's inflation easing. Now, I know just recently it kind of ticked back up, but I do think that it's going to continue to ease. The Fed saying, look, we're not at least raising rates. They may cut, but they're not at least raising rates. So that's creating investor psychology that is more confident. So I think that's what we need, is that sentiment that is more confident. And there is a lot of capital, over $450 billion that has been raised and needs to be deployed into real estate deals. So I see that all trending up in the right direction from a price per square foot and price per door basis. What that looks like for us from an acquisition standpoint this year, I'm still uncertain but one thing I am trending in looking at is, look, there's more baby boomers turning 65 this year than more than any other time in history. And what does that mean? Well, they hold over $7 trillion of real estate. That's just on the residential side. I got to believe they have a decent amount on the commercial side as well. So as these individuals do get older, they are going to be looking to sell that real estate because there's a lot of times where their heirs just do not want to do anything with that. So I think that does create maybe in the next 2 years some more transactions that are going to happen as well.
So January 2025, where are the rates going to be at?
Oh man, I sure hope that we can go get a loan at 5.5%. I'm looking at it maybe kind of similar to 2018, 2019.
So SOFR is going to be SOFR is going to be like at 3.5 then.
Yes, exactly.
Okay, great.
Logan.
Let's see. Okay, so last thing we want to end the show with. Last time you were on, you taught us about this concept of immersion, where you don't just read a book. We hear a lot of times things online on social media about how CEOs read 8 books a week. Like it's I call BS on some of these things, and it's not really reasonable, right? It's not about how many books you read. It's about what you learn and how you implement it. And you talked about when you read books, you actually immerse yourself in a book, and you actually try to, for weeks and months in some cases, and you try to use what you learned from the book and implement it in your life.
And that's actually what we're doing now. That's when we read a book, that's actually what we do now. We think about you every single time.
Yeah, we get a highlighter out, we read it over and over again, and we try to implement it in our lives. Yeah. We want to know if you had any other, secret sauces that you use in personal development. You talked about cold showers on our last show, but maybe cold plunges that are really in these days. But maybe also on other things where it's you pretty much run 2 companies on your brokerage side and your private equity firm. Is there any personal development?
3 children.
And you have 3 children.
Yes.
Yeah.
Yes.
Congratulations on the most recent one a few months ago. But is there any kind of ways where you can implement ideas that you've learned from books in personal development or in building companies and, so on and so forth? Tell us something you can use this time.
Are you ready to be leveled up? Because
we're ready to be leveled up.
This is a game changer. Okay. So now that you have immersed yourself into a book, can you sit down with a 10-year-old and teach the concepts out of that book? Can you teach that concept to someone in a simplistic way that they could be able to understand it? So that is the next level. And so one book that I will just say how I've done this is Never Split the Difference. I have been able to take the concepts of mirroring, of labeling, of accusation audit, of tactical empathy, all of these things, and I actually use those in coaching with my kids. Now I only have a 5, a 3, and a 1-year-old, not even a 1-year-old, but being able to actually teach those concepts out of a book to employees and to other people. That's the first one. The second one is ChatGPT. And here's where it gets really cool. So I have been messing around and playing with ChatGPT in the sense that those book reviews that I write, the concepts that I take out of those books, I put them into ChatGPT in a text format. And I say, now that you have the summary of all of the concepts that I want you to play Chris Voss, the negotiator, on the other side. And we're going to start negotiating this real estate contract live on ChatGPT and help me respond in a way that uses those concepts out of the book. So that is really interesting because here's another one. Okay. If you have mental models from Charlie Munger, you can upload mental models into Charlie Munger and say, I have a challenge that I am trying to figure out how to think through the mental model of inversion. You lay out the challenge and you say, give me 5 different scenarios that helps me to invert this and elevate my thinking. And now you're talking with Charlie Munger in regards to inversion of that mental model. One really cool way that I'm utilizing this is I'm really big on personality and skills assessments, but that only just gives you a marker. It gives you a, hey, I'm an individualist. I'm an achiever. I'm a competition. Okay, cool. What do you actually do with that? So what I've done on the brokerage team is I've had them all take Principles U from Ray Dalio. It's a free assessment. I had them send me all of their results. And what I did was load all of the results up into ChatGPT and say, okay, here are the 8 people that I have on the brokerage team. How do we best work together? But more importantly, when a challenge comes up, how do we work through this challenge? And tell me what challenges may come up between these 2 individuals. these three individuals.
Compatibility and
Compatibility. So you're taking those concepts, you can teach them, but you also can run almost regression models with ChatGPT with those concepts and do mock scenarios in those. And I tell you what, guys, it has been an absolute game changer for me to understand other people's perspectives based on their strengths and their skill sets.
amazing.
Wow,
We're going to talk about
Logan,
this
that
next
is
time we
so
have you on the
cool.
show.
Yeah, absolutely.
Thank you. Thank you,
Wow.
Logan, for coming on, man. Really appreciated your wisdom as always. Thank you for giving us your time and telling us about your new venture. And we're excited to see. I see your emails coming in, so we should definitely have a chat soon.
Yeah, we always
Yeah.
appreciate you, Logan. Thank you so much.
Thank you guys for having me so much.
Thank you for joining us for this episode. We hope this conversation enlightened you on how to win big in this highly profitable and risk-averse space. Get on your feet and embrace this world that offers so many opportunities just waiting for you out there. Continue your journey to becoming a savvy real estate expert by subscribing to the show at cpicapital.ca. Don't forget to leave a positive rating and share with your friends. See you on the next one.